Is a 2022 style storm building for Meta again? On one side, there is a business that generated $61 billion in quarterly revenue, 80% gross margins, 38% operating margins, growing at 25% plus. On the other hand, are unproven and risky, aggressive AI bets with, at best, lagging AI capabilities and youth safety trials starting this month. Let's analyze Meta stock after the Q2 results and see if there is asymmetry in the stock at this price point. Quick disclosure, I own Meta stock since 2021. Welcome to Asymmetric Bets. My name is Anurag Gupta. Asymmetric Bets is an educational channel where we apply ACT framework to different companies. ACT stands for Asymmetric Compounders with Time Advantage. A quick disclaimer, this is not financial advice. This is only for educational purposes. Please consult your financial advisor before making any investment decisions. With that, let's jump into Meta and how its Q2 26 earnings shaped up. If I were to describe or show my feeling about Meta without uttering a single word, I will actually show you this picture. And I will let you marinate on it for a few seconds here. And here's why I feel this way. Here's a quick snapshot of the financial performance that they reported in Q2. If you look at the revenue jumped 28% year on year to $61 billion. Other revenue crossed $1 billion for the first time. This is primarily WhatsApp paid messaging and subscriptions. Engagement on Instagram, Facebook, both up very healthy globally. Yes, the operating income was down 8% year over year, but I think this is where it becomes important to not get carried away by the headline number and look into the results. In this case, Meta had quite a bit of one-time expenses, $2.4 billion in legal costs, $1.2 billion in severance costs. If you exclude all of that, the operating income actually went up 9%. Now, granted, 9% is lower than 28% revenue growth, so their operating margins did go down, probably because they are investing in hiring AI talent, which is expensive. But I think the real story is well depicted by this chart, which is ad impressions and price per ad over a period of last 5 to 6 years. And if you look at this, recently in last 2.5 years, their ad impressions, they have grown a very healthy double-digit clip, and they're actually accelerating. In the latest quarter, impressions, which is a proxy for engagement on their apps, were up 14%. More importantly, let's look at price per ad. And this number again has been up every year for last 2.5 years, and it's accelerating as well. So in this latest quarter, it jumped 12%. So what that means is Meta has the pricing power as well as higher engagement from its end users. And this is not something that has always existed. If you look at 2022 and 2023, the ad impressions were actually going up, but the pricing per ad was coming down. And this is the time when Facebook was competing with TikTok. It was facing Apple related privacy issues, because of which it had to actually sacrifice price and drive engagement on its app. And all that investment in building Reels capability and adjusting their apps for surfacing those short form videos is now finally starting to pay off. And we can see this consistent trend, double digit on both ad impressions and price per ad. Why my perspective may be helpful to you. I've spent 20 plus years working with senior executives, helping them with business strategy, leveraging data and commercial insights. And this has given me a front row seat into how businesses compete, grow, and create value. I've also been a student of investing, reading annual reports, going through earnings calls, looking at valuation and capital allocation strategy. I go beyond stock prices into first principles, understanding business economics, moat, competitive advantages, and thereby the long term wealth creation potential of businesses. I'm committed to transparency. I may not be right all the time. In fact, nobody is, but I will share my reasoning and thought process with you. So, Zuckerberg talked about a two-pronged strategy for AI for Meta. And I've tried to depict all of that here in this one picture. If you look at the left-hand side, which is the consumer side, that is what is active and live right now with 3.6 billion users, with all these apps deeply embedded in the popular culture, churning billions of dollars at 80% gross margins. And then there are apps relatively young like Threads, which already has hit 500 million in user base. And Mark's point was that with Meta's AI capabilities and its reach, it will be able to create more such apps in the future, scale them, and then monetize them. And this is one of the flywheels that he talked about. He also talked about personal agents and how they are coming in the future. And the challenge with the personal agents is not how quickly can Meta create them, but how quickly or how efficiently they can create something which can be used by billions of non-technical users and something that just works. But that's something which is coming in the future. And all these things are right now powered by AI. Just to give you an example of things that they've highlighted on their earnings call is they are training their AI models to understand each and every piece of content that's out there so that they can map that content to the preferences and the likings, and what the users are interested in a very efficient manner. And they can do the same thing from an ads perspective. They can find out which content makes sense to put what ad in. And all this requires a large amount of AI investment, which they're making. But let's move on to the right side now. Mark also talked about the enterprise side of the business. This is still aspirational. This is still something which is under building, but he talked about three distinct opportunities here. The first one is being able to license APIs, leveraging their models. The second was to be able to license out business agents on, let's say, for example, WhatsApp messages and business agents on WhatsApp or Messenger. And the third thing he talked about was selling compute. He talked about how they had multiple offers at a premium to what they paid for the compute, but they chose to decline that because they feel that being able to sell and monetize intelligence is going to be greater return on investment than trying to simply monetize compute. But the right hand side is completely unknown, and this is the risk part. Nobody knows whether this will pan out or not. But nonetheless, even if the right hand side does not pan out, the left hand side is just a phenomenal business, and leveraging their half of the people on the planet, and the fact that they have their own proprietary AI models, and all this engagement, advertisements on these apps generate data, and that data they can use to make their AI better, and which can then again feed and make their apps better. And this kind of flywheel kind of keeps going, and they can continue to grow because, after all, what is the alternative for Meta from an advertiser's perspective? I would argue there isn't many options for advertisers to go and go to an alternate source of 3.6 billion users. But anyway, I think this is something he talked about from a vision perspective. But he also, gave away the moat of Meta, and I'm sure you guys will be surprised when you hear this. But as per Mark, the core moat, the core secret sauce of Meta is not their apps and software. What their core competence is not their software and Facebook and Instagram and all these things, but it's these 4 or 5 things. First, they own the entire technical stack from the silicon, so they are developing their own custom chips. They are, of course, spending like crazy on data centers, so they have their own data centers, and they have their low level software. So I'll give you an example what he means by this low level software. I happen to know a few people in Meta who work there, and when I talk to them, one of the things that was a revelation for me was that Meta does not use any of the software products that are sold by third party software providers. They develop their own software, and a lot of that software is similar to what's there in the market, but it's their own. So they don't incur any cost to use that software, and more importantly, they are not dependent on what's the roadmap of those software providers. They can do things to the software which best meets their business needs. And that's what Mark highlighted, why they have to invest heavily in Meta, in AI, because they don't want to be dependent on third party LLM model and frontier model providers. They want to have their own model so that they can leverage the data generated by these 3.6 billion users. And if they have their own AI, their own frontier models, they can move at their own pace. They can develop custom models that work for them. Now, let's look at the business's economic characteristics real quick. I did highlight a lot of these things already, but here's a chart for last several years, and as you can see, on the purple here is the revenue growth, and there was, of course, a dip when there was a perfect storm that happened with Meta in 2022 and early 2023. But after that, they've just been growing, phenomenally. For a company of this size, they're still growing 28%. Their gross margins are close to 80%. Their operating margins have been around 41 to 43% recently, has come down, but it's a 40% gross margin business. So I think all in all, looking at these characteristics, it's a money minting machine, as I mentioned, and I showed you that picture. And if this kind of a business is available at a reasonable valuation or a cheap valuation, I think that's phenomenal. And let's look at what it looks like on the ACT lens. So let's start with asymmetric. Here I'm looking at few metrics: price to sales, price to EBIT, free cash flow yield, price to book, and I'm looking at the current valuation, what it has traded on an average in last 10 years, as well as I think it was important to look at 2022 trough multiple that it received on all these metrics, because it gives us a sense of the worst case that we can expect in Meta. And on all these metrics, the current share price, the current price is actually lower than its 10-year average, anywhere from 22% to 33%. And I know cash flow yield is going down because it's aggressively investing in AI. But if you account for that, then it is definitely below 10-year average significantly. And if you look at 2022 trough multiple, that is significantly lower. Of course, that was just a crazy valuation that Meta received. But if you look at that, then it gives us a sense of what is the downside. So, in worst case, it can go down 50% more if it were to hit that trough valuation on price to sales, for example, actually more than 50%. So let's say 50% is our downside from a risk perspective. In terms of growth that we are getting at this price, and I'm looking at share at $590 per share, growing at 28%, which is higher than 10-year average. So its growth has accelerated, and again, AI is contributing to that. EBIT growth a little bit more muted, again because of depreciation, amortization, and all the expenses on AI. Free cash flow, as I said, has dipped. Book value has grown, so that means they're not distributing the cash out to shareholders or buying back shares, but they're investing and keeping that those earnings, and that is increasing their book value by 34%. So all in all, the crux here is that the current valuation is below the 10-year average, not just a tad below, but significantly below the 10-year average. Revenue growth is above trend. Business is heavily investing in reinvesting in the business in AI. So the book value and free cash flow yield is depressed. And if you look at the trough multiple, then I think there is maybe 50% maximum. If everything goes wrong, then I think it's safe to say 50-60% is the downside that can still happen in Meta, but it's a far-fetched worst case. Now, here's my summary on the ACT lens. I think we all understand compounders in time, but I'll take you through that. Asymmetric, low risk, high potential. What I feel is less than 7 times sales, 41% EBIT margin business, normalized. It may not be doing 40% right now, but that means you're paying 16 times operating earnings, which is not terribly expensive. It's actually attractive. I would say, especially if you take into account the fact that it's growing its revenue by 25%, actually 28% in the latest quarter. The risks beyond the share price going down, or risk that can actually lead to the share price go down by 50-60%, is the legal troubles that we are going to talk about. If the heavy AI spend results in low ROI, the growth rate dips, or they're not able to leverage it to penetrate into the enterprise side of the business, all those are risks. In terms of compounding, it's a leader. As I said, there is no alternative for investors to look other than Meta, for with 3.6 billion users and still growing, historically 30% ROE. And if you look at the long-term trend of the ROE, it's pretty encouraging. We talked about the pricing power, how price per ad is growing double digit for last 3 years. Future potential, it has apps that it has not fully monetized, Threads, WhatsApp. There are more apps coming in the future, personal agents. There's an opportunity with enterprise business if it is able to penetrate that. And then it's a founder-led business. And I would say not just founder-led, but it is one of the geniuses that is operating this business. And Mark Zuckerberg is actually not the only genius who's investing heavily in AI. It's also Elon Musk. And SpaceX just reported a massive CapEx plan. And Elon talked about how that is going to accelerate and that is required. So I think if a couple of geniuses are saying that AI, investing in AI is the best strategy, the best use of capital, I would not discount that entirely. In terms of time, yeah, it has phenomenal track record of amazing financial performance for last 12 to 13 years. It's an advertising machine, especially for large enterprises, aspiring brands. Again, I would like to tell a story here. I was listening to a consumer analyst, and he was talking about how large consumer companies, like any name, you pick any name, General Mills or beverage brands, they're facing a lot of competition from smaller upcoming brands that are leveraging TikTok and Instagram to actually penetrate and grow share. And for those kind of brands, what's the alternative other than Facebook? I don't think there are too many alternatives other than Facebook and TikTok. So it's a phenomenal asset for those brands, as well as over 9 to 10 million small to medium businesses that leverage Meta, as well as AI driven innovation boom. I think with AI, a lot of people are going to become entrepreneurs. They're going to start their businesses, and they are going to reach their consumers, their customers, through apps like Meta's family of apps. So all in all, I think there is a phenomenal potential and future runway for Meta. But I think, so I rated it on all asymmetric compounders and time. I think it's a check for me. But having said what I said, I still feel that there is a small probability of a 2022 style perfect storm coming Meta's way. And there are two, three risks that I've already talked about: disappointment with the AI capex, legal outcomes from the youth safety trials that can lead to a large fine. And Meta called this out in their quarter two earnings call, that it can lead to a material loss. But more than the fine and the loss, if they are forced to make changes to their products, that can actually impact their revenue growth. And lastly, with all these commitments for AI spending and infrastructure spending, if there is a macroeconomic shock, then Meta will not be immune to that. And that's a risk as well. Having said that, I think the situation right now is very different from 2022. In 2022, their revenue growth actually was zero. It was actually, they experienced the first ever decline in year over year revenue, whereas right now they are growing close to 30%. Their operating margin had back then compressed to 25%, which is now healthy at 38%, even though it has gone down and it may go down further. But that is an intentional decision because of the investments and not externally driven. Same with the ROI. Back in 2022, it was collapsing, and a lot of it was because of competition from TikTok and Apple's privacy changes. The capex that they were choosing to do in 2022 was on Reality Labs, which was a completely unknown and unrelated area for them. The chances of success there were limited, but now they are doing capex on things that are going to actually lead to better performance from their family of apps. And as an example, Advantage Plus, they talked about how it's a $75 billion run rate business and it's completely AI driven. In terms of the overall nature of stress back in 2022, it was both top line as well as bottom line, and there were external factors, and it was not known how Meta will cope up with that. Right now, it is them choosing, their founder, who is also a genius, choosing to deliberately spend aggressively on AI, and their top line is accelerating because of some of those investments. So I think the setup is significantly different from 2022, but who knows, when they are in front of a judge defending against youth safety trials, there'll be large numbers that will be estimated by analysts, and they'll be thrown around, and the stock will react to it. And that's when it can give us opportunities, together with negativity on AI spend and them also being laggards on AI. It's not that they're spending all that money and they are at the forefront. So all those things can lead to a better price as well. So friends, this was my analysis for Meta stock after the Q2 earnings call. Personally, I would invest a little bit of my additional capital that I want to deploy now, and then rest of it I will stagger as the news flow becomes more negative, and try to leverage this youth safety trial and other news flow about Meta. Let me know what you think about it. If you like this kind of content, going deeper into first principles and analyzing the underlying fundamentals of the business rather than chasing the hype and the stock price, please like and subscribe to this channel. I greatly appreciate all the time.